The Fed is composed of three key entities: the Board of Governors, the Federal Open Market Committee, FOMC, and the 12 regional Federal Reserve Banks. The Board of Governors is the main governing body of the Fed. It is made up of 7 members who are appointed by the President and confirmed by the Senate. The board is responsible for setting the direction of monetary policy and overseeing the operations of the other parts of the Fed. The FOMC is the main monetary policy-making body of the Fed. It is made up of the 7 members of the Board of Governors, the President of the Federal Reserve Bank of New York, and 4 other regional bank presidents who serve on a rotating basis. The FOMC meets regularly to discuss the state of the economy and to determine the appropriate level of interest rates and the amount of money that should be in circulation. The 12 regional Federal Reserve Banks serve as the operating arm of the Fed. They are responsible for implementing the policies set by the Board of Governors and the FOMC, as well as providing financial services to banks and other depository institutions in their regions. The Fed has several key functions that impact the economy and financial markets. These include implementing monetary policy. The Fed uses its tools of monetary policy to influence the demand for credit and the level of economic activity. It does this by setting interest rates, which can affect the cost of borrowing and the level of spending and investment in the economy. When the Fed raises interest rates, it makes borrowing more expensive, which can slow down economic growth and inflation. On the other hand, when it lowers interest rates, it encourages borrowing and spending, which can boost economic growth. Regulating the money supply. The Fed has the authority to control the supply of money in the economy, which can impact the level of inflation and the stability of the financial system. It does this by conducting open market operations, which involve buying and selling government securities in order to add or remove money from circulation. Providing financial services. The Fed provides a range of financial services to banks and other depository institutions, including lending them money, processing payments, and providing them with access to the payment systems that enable them to clear checks and other transactions. Maintaining the stability of the financial system. The Fed plays a critical role in maintaining the stability of the financial system. It does this by providing loans to banks and other financial institutions during times of financial crisis, and by implementing regulations to prevent excessive risk-taking. Overall, the Federal Reserve plays a crucial role in the U.S. economy. Its actions can impact the availability of credit, the level of economic activity, and the stability of the financial system.